each client's different. There's going to be little different things that are going to be, whether it's their risk tolerance, risk capacity, whether it's their goals or where their starting point or where they want their endpoint to be. So all of our portfolios are managed individually, which is, again, a little different approach. An easier approach would have been to say, hey, we'll have a pool and everybody gets a piece of that pool. But I think it's better to build them for these specific situations. And that is even with a client. You can have your non-qualified assets and your qualified, and they can have different allocations, different models.
Welcome to the Active Advisor Podcast, brought to you by Harbor Capital. Join us as we learn from pros who have helped thousands of investors live better lives. I'm Bryan Moore, and I'll be chatting with some of the brightest minds in the financial advisory business, bringing you insights on practice management and investment research that works for advisors and their clients. Joining me today on this episode of the Active Advisor Podcast are two distinguished guests from SKWealth Management. First up is Jason Archambault, CFP, CPA, PFS, who is the founder and chief executive officer of SKWealth. On top of overseeing all the day-to-day operations of the firm, Jason specializes in advising clients on all things wealth management and financial planning. Second is Matthew Neyland, CFA, CAIA, who serves as the chief investment officer at SKWealth. With over 30 years of experience, Matt oversees all investment management activities, and his work encompasses research on the financial markets, the design of investment policies, building client portfolios, execution of trades, and monitoring the portfolios. SKWealth strives to provide financial peace of mind for their clients through an engaging, evergreen, fee-only financial process that serves as a foundation for protecting and growing portfolios. Without further ado, welcome, gentlemen, and thank you for joining us.
Thank you.
Now, typically here on the Active Advisor, I love to get the conversation started by asking each of our guests, what is the first memory you have related to money or investing? Let's start with you, Jason.
Well, actually, that comes to mind pretty quickly. And I think it was the first time I had an allowance. And believe it or not, it was 50 cents a week. And I remember saving that allowance up in order to buy things. So it's changed a little bit in the way I've done things in my adult life. But that's my first relationship with money, is that allowance and how I had to manage it.
Excellent. Thank you for sharing. It's funny how a lot of people go back to that first allowance because you think money's infinite until you have to be like, wait a minute, I've got to actually piece this out and actually kind of decide what is it I really want. Matt, would love to hear your first memory related to money or investing.
A little bit differently. Mine actually came in college when I was a very poor college student and just learning how, hey, I got to figure out how this is going to work if I'm going to eat and live. So it became an interesting thing, as college, you explore and you meet different people. And one of the things I met was a person whose father was a broker at that point in time. And I developed a relationship, actually got my Series 6 or Series 7 license through him at the time just to kind of dabble with it. So it was a neat way of kind of learning how money works, from that sense and how you can make it grow in different ways.
Oh, that's awesome. It's funny doing this for a while. It's either the allowance or it's definitely has something to do with college as well. Because that freshman year is obviously kind of eye-opening in a lot of different factors and reasons. I'm going to fast forward here just a couple of years. Yeah, would love to talk about we're going to dive right into kind of the, SKWealth Management. Jason, you've had a really interesting journey from a CPA to the CEO of SKWealth. Can you walk us through the story of that transition? And love to hear, kind of curious, what's your take on and what's your projection on how the firm has evolved since then?
Yeah, sure. So you're right. I started my career out of college in a Big 8 at the time, accounting firm. That office closed and they wound us up in a bigger office. So I stayed local and I joined the accounting firm of St. Severian and Kimball, part of our affiliated accounting firm today. And that was back in 1989. So I did that CPA work for about 10 years. And there was one summer when I didn't want to get out of bed and go to work, which was very unlike me. And so I started thinking about what was causing this. And I realized that as much as I liked my clients, I was there because somebody else wanted me to be there. So no one would get a tax return prepared if the government didn't require it. And no one would also, get an audit if someone wasn't requiring it either. So as valuable as the services that we provided, the job satisfaction wasn't so great for me. And I started to think about maybe perhaps going back to school, starting something else, but that's a large endeavor as well. Kind of back to Matt's college story. I put myself through college. It was a lot of work. It was a lot of money. And I was kind of thinking about how would I do it all again. So coincidentally, our accounting firm had an offsite retreat, and one of the presenters at that retreat was a financial planning firm. And all the light bulbs went off, and I was like, wow, this is really interesting. I think this is something I'd like to do. So long story short, I didn't know it at the time, but the partners of the accounting firm were in talks with the owner of the fee-only financial planning firm that gave the presentation, because we were doing a lot of referrals back and forth for tax work and financial planning. So they started a joint venture with them back in 1998. And so I was lucky enough to be on the ground floor of that, to be basically the first employee of that, trained with the fee-only financial planning firm, took that back to our offices and started providing that service to our clients. That's how we got started. Fast forward a few years, just about 10 years, we were big enough where it wasn't exactly working well for the joint venture. So we decided to go out and do our own thing and get our own Matt Neyland for our chief investment officer and have everything in-house. So that's the journey that got us there. And that, like I said, that was about 2008. I think Matt was maybe the third or fourth employee. So it started off slow and added the first employee for a couple of days a week, and then 3 days a week, and then a second employee, and so on. So that's the origin of it. It's obviously expanded to not only include the accounting firm clients, but of course, more of our clients are not related to the accounting firm these days than are related to the accounting firm, but we still share a good amount of clients together.
Well, that's good. And definitely those two lines of business in the finance world seem to go hand in hand to a large extent. And I think when you can look at it as a holistic relationship, it definitely brings a value add to not only planning and your clients as well.
When I started with the firm in 1989, we did have a certified financial planner on board, and she was doing financial plans, charging like much more than we charge today, believe it or not. But then she would have to leave them all and go on to the next one because the laws at the time didn't allow accounting firms to manage assets and do that kind of work. That all changed. And so we took advantage of that change and like I said, started SKWealth.
That's great. Matt, you joined the firm in 2008, which obviously a couple of years after, it seems like it's definitely was evolving on its own. But you really bring a different wealth of experience in the financial services industry that's very complementary to what Jason and the rest of the team are doing. Can you talk a little bit about the journey that led you to SK Wealth and your role as CIO?
Yeah, so I came from a different world, but still within the investment management side. All my experience was with institutional investment management. I worked my way up from a trader up to a portfolio management role. And it was a great experience because I got to see how, in a sense, Wall Street works, and got involved in a lot of different product types. We did a lot of private investing as well. So it was great to get that broad experience of seeing all those different things and how they come together, all the way down to the transaction. And I think starting as a trader too was very valuable because a lot of times we take for granted how these prices are derived with securities that we invest in. And it was really important to see really how it all came together and then how to actually execute those transactions. It's a little bit like seeing how the plumbing works on your house. And I thought that was a very valuable role. But one thing is, as I was going through time, managing institutional money, obviously there's differences, but I think one of the things is if you think about managing institutional money, it's like managing for an entity. And so it's a little bit different, the kind of communication you have with the client and the relationship you build there. And one of the things that always intrigued me, because I was always been working with individuals and having an impact that way. And so it was very interesting. And the timing couldn't have been more interesting, 2008, when the world was falling apart, and to see this opportunity that there was at Jason's firm. And I really delved into it because I didn't know a lot about the registered investment advisor space or the RIAs. I really was more familiar with the brokerage model. So it was really interesting to delve in and see that model and see the way Jason built it was that it's an integrated approach, that we're not just doing investment management and then checking in with the planners. It all comes together as one. And that really intrigued me. And the fact that I get to work with individual clients. So in the end, the timing of it was very good because there was a situation where if clients ever needed handholding, 2008 was it. And so to come in at that point in time and to be able to kind of talk them through the process and give them a level of comfort in a very difficult time It was very valuable. And it's one of those things that I'm very glad I made that change.
That's awesome. And I loved hearing your comments about being a trader. And I think that really, as somebody who started that way as well, I think it really does give you a scene kind of behind the curtain and really kind of can help you kind of process and see the whole flow and how things work. You've sold me on kind of the integration between the wealth management side and the accounting side. I've definitely been a fan of that model. I think it really brings a whole different level of expertise to the clients and to all the parties at the firm, because they can kind of look at things and think of things in a little bit more holistic atmosphere and sense. I'd love to hear a little bit more about what you guys believe is your value proposition at SK Wealth and your overall philosophy on investing. Jason, if you wouldn't mind, could you talk a little bit about the size of your firm and the client experience that you offer?
Sure. Our firm, from a team perspective, we have 9 team members right now. 5 of us are advisors or associate advisors for our clients. And we also have Matt, our CIO, of course. And we have 3 people in our back office. So we have a director of operations and 2 client service specialists. So from a client perspective, a client always has 2 advisors on their team, as well as a client service person and Matt. So that's every client is situated that way. So if one of us isn't here, the client can reach out to another team member if there's something going on, if one of us is out or anything like that. So from that perspective, we have those 9 folks, and that's the way it's structured around our team. From a size perspective, we manage about 550 million assets as of right about now, and that represents about 300 households that we're working with. So it gives you a little flavor of the amount of clients that we're working with as well. As you kind of mentioned, and as Matt alluded to, we've always considered ourselves a financial planning firm that may do money management, but we're not a money management firm that might do a financial plan. So all of our clients are expected to come to us with financial planning issues, really. That's where we feel like the connection is the strongest. So we're going to be dealing with financial planning issues, working through what their goals are, what their cash flows look like, making sure from a risk capacity perspective and what their financial plan needs as a rate of return, all kind of pulls in together to go and formulate what the portfolio should look like. So we call that the integrated financial advantage, because everything is connected and it all leads up to how we can direct Matt to say, this is the type of portfolio we need for these reasons. And then Matt goes ahead and does the portfolio construction around that.
Just in kind of hearing what you mentioned there, I think getting to that kind of level of expertise and kind of knowledge and depth about the client and kind of their situation and their goals and outcome has to require asking a lot of questions and establishing goals with them early on in the process. Would love to hear, what is your take on that? And do you believe is the most important first step in establishing those goals?
Questions are, really important. So a prospective client comes in. I don't think anyone wakes up in the morning and says, I need a financial plan. There's some pain point going on. There's something that's coming up or that they're wondering if they're dealing with correctly that gets them to reach out to us and come and talk to us. So asking those questions about what got them into the office in the first place, but it also leads to other questions that they may not have the answers to or even thought about. So those questions are very important. In fact, I end up every prospect meeting that I have asking this question about, and the question is, if we were here 3 years from now working together and you look back on those 3 years, what would have had to have happened to make you happy with your progress, both professionally and personally? And that uncovers a lot of stuff that maybe just numbers don't for a financial plan, because at the end of the day, it gets down to values and what's important to a client. And yes, we can get them and help coach them to get them there, but without knowing where we're going, we can't give that recommendation. So asking the questions is extremely important, and we ask a lot of them. So when prospects ask a lot of questions of us as well.
I think you have to. I think that shows interest on both sides, if I may surmise. But all these questions, Matt, lead back to you. I think you're where the rubber also meets the road here. Would love to hear, after Jason and team, and you've been able to kind of ask the questions, I'd love to hear about your approach to building client portfolios.
This is, interesting. As you well know, there's a lot of different ways you could manage portfolios. And the one thing that we do, and it helps with the financial planning process to come up with this, is each client's different. There's going to be little different things that are going to be, whether it's their risk tolerance, risk capacity, whether it's their goals or where their starting point or where they want their end point to be. So all of our portfolios are managed individually, and which is, again, a little different approach. An easier approach would have been to say, hey, we'll have a pool and everybody gets a piece of that pool. But I think it's better to build them for these specific situations And that is even with a client. You can have your non-qualified assets and your qualified, and they can have different allocations, different models. But from an overall firm standpoint, you also have to find ways to be efficient. So in our investment committee, we derive a list of approved investments that we can use in portfolios. And we also approve a general list of models that we run off of. So each model has the flexibility to be a little bit different, but it's also a nice guide for us to know. And it's a nice guide for the planners, because when the planners go through and, say we're doing some rebalancing in a portfolio, or just a new client's coming on board and we're building a portfolio, it's nice for them to see, here's a guide for what the portfolio should look at like. So we have a second set of eyes on it at all times here as well. But I look at the world, the world's definitely evolving, especially in the investment world. And I think some of the traditional ways of investing, sure, have their place in portfolios, but I think you have to realize the things that are happening too in portfolios. Correlations among asset classes have shifted and changed. The relationship with the news flow and how it flows into the market movements has changed. So I believe that you have to look at things a little bit differently. And we build our portfolios so that we, in a sense, an all-weather approach, meaning that the portfolios can last through multiple climates, whether it be changes in economic climates, changes in market climates as well. So that means we have to take a longer-term view of what we're doing in the portfolios too. We react to the near term, but we've got to keep our eye on that longer term as we're building these portfolios. So what some of the changes recently that we've been doing in portfolios is, instead of just having the typical stock bond mix in portfolios, we're adding in other components. We kind of throw them in a bucket we call alternatives, but really they're the type strategies and asset classes that could even look like maybe traditional bonds from a downside protection standpoint, but they change from bonds in that they're built to be asymmetrical. Protect to the downside has got to be number one, but we want to be able to participate in up markets too. We don't just want interest rates to be the reason that they can participate to the upside. So that's been an important change. So when you look at our non-stock portion of our portfolios, it's much different than it has. And I even call it non-stock now, because instead of just saying it's bonds, because bonds now are a much smaller portion of the portfolio than they used to be. And the other recent phenomenon here is that we all get to and have been able to enjoy is that cash yields have been much higher. So we've used more cash type, high yield type money market strategies within portfolios, take advantage of that. The Fed's about to pull the rug out on that for us a little bit here, but it's been something, again, reacting to changing environments to build the portfolios to fit the specific client needs.
No, that's a great answer.
I agree with that. And I also wanted to mention that when we're doing a financial plan update, we're also always coming back to those allocations that we've set up that Matt is working on, and looking at the financial plan to see if there's any need to change those. So it's not that we react to market situations and say, oh, we should change the portfolio because this is going to happen. More like, is something going to change in your financial plan that would cause us to change those allocations? So it's the circular piece where the plan is looking at the portfolios, and the portfolios are looking at the plan as well.
It's almost the circle of life, as Disney would have us believe there. But it actually is in the financial world. Yeah, I think one of the things that, in speaking with advisors and definitely being a trader, I think coming from the trader seat, Matt, your world was much shorter duration. And then you switched to institutional. How are you getting not only yourself comfortable with kind of that longer term duration? That's obviously something that you're using kind of just intelligence for, and the market's kind of letting you know. But how are you also able to work with your clients to get them comfortable with that?
Yeah, it's interesting. That's always still, as it's always in your heart and in your head, that you're watching every tick of the market. But at the same time, I think the interesting thing for clients, and this is, again, to harp on this, is that the financial plan is always there to keep clients' eyes on the horizon. And that is so important because, let's face it, the best diversifier on the planet is time. And the more time you can give clients to get comfortable, the better things the outcome can be for them. When I communicate with clients, I make sure, like, most of my communication is not much what happened. It is about what may happen going forward, and spending a lot of time at looking at, we do a lot of scenario analysis and testing in portfolios to say, what if, this happens? And that to me is a big thing for giving the clients a sense of calm. It's like I'm sitting in the client seat and I'm saying, wow, this team is thinking about what may happen and they're planning it ahead and being prepared ahead of time. And that to me is a real important thing to keep them calm through multiple market environments. People are always going to be nervous, but I think as we've been working very hard to build up their trust, that we're always thinking about their plan. And as Jason said, I think a great thing, let's go back to 2022 when the markets were, going haywire. Clients would call and then they would talk to the planners and the planners would say, okay, we're here at this point in time. 2022 is happening or it's happening. And they said, let's look at what's happening to your plan. Has your plan been destroyed, because of this market? And give them that sense of calm to say, hey, this is just a moment in time. This hasn't disrupted your overall long-term goals. And I think that's really valuable. And I try to reinforce that with my communication with clients in saying that there's a big disconnect in the world nowadays, the way the markets trade. It's such a reactionary world now when the news comes out. But so many things that the movements in the markets now are non-fundamental reasons. And that's an important thing in my seat to decipher. What's just kind of a feeling or a whim or a rush to one side of the boat type trade versus a fundamental change. And a lot of times we're seeing that it's probably 25% fundamental, 75% reactionary type moves in the markets nowadays. And to give clients that experience and understanding of that has been really valuable for helping them get through periods like 2022 or 2008, you name it.
I will put an exclamation point on that fact of us being able to pull up a client's financial plan and say, yes, your accounts are less than they were the last time we did this, but your plan still works. And while nobody likes to see negatives around their performance numbers, but when they see that everything is still working, Matt's exactly right. Then they have a little more confidence and they calm down a little bit, and we can talk them off the ledge a little easier with the tools that we have versus just saying it's going to be all right. Just give some time. We can actually show them, even if it doesn't rebound, you're still okay. And if they're not, in a rare case, if they're not, then we know what kind of actions we can take to get them there, and they have a plan. I think a lot of times we don't do much when it comes time to if there's something going on in the markets, we're not doing anything on purpose, and that's sometimes tough for clients to hear. But if they look at their plan and they see that it's being addressed within the plan, then at least they feel like it's being addressed and that they're being paid attention to.
I think, you both gentlemen have touched on, I think, two of the key aspects of kind of working with clients and having them stay in longer term. Is that basically also adjusting and kind of, making sure you're staying in touch with them regarding those life-changing moments and kind of, philosophy and kind of anything else that may change the plan. And Matt, telling them we've run these what-if scenarios. We've got a plan for the plan. So I think both of those things obviously provide a lot of great comfort to your clients. And I think one of the things that's most interesting to me is, would love to hear from you, Jason, to start. Is there a specific story or example that sticks out in your mind where you've made a positive impact in a client's life?
Well, I hope there's a lot of them.
True, me too. But I think providing reassurance from both sides of the coin here, I think it really, hopefully there's one that kind of sticks out, because I think those are the stories that I know people like listening to, and as do I. And obviously, you have to be able to tell yourself when kind of the market's having a tough day that you're doing right, you're doing good stuff.
Yeah, in general, I feel like I've been very lucky, and it's been 26 years and I've had clients that long, and being able to see their whole journey, and they're doing the heavy lifting, they're earning the money, they're socking it away. We're doing the coaching and helping along the way, but I do feel like the results are theirs, and with a little help from us to guide them in the right direction. So there are lots of times when we've had to give clients maybe bad news, like what you're doing, you can't sustain, or maybe just helping them do it with the good news and helping them keep going on what they're already doing. But I think one of the more recent ones was I was meeting with one of my clients that has been a client since the beginning. And we realized that at this point in time, I'm older than he was when he started working with me. And we were just joking about all the things that happened because his kids were, starting to go to college and all that. So now his kids have kids and those kids go to college. So, it's been a journey and very gratifying for me personally to see something like that. So starting off with a brand new client is exciting and fun. It's a new set of challenges, but also going through the existing clients and looking back at all they've been able to accomplish. And, the hand holding goes into that, and being able to help along the way and looking back and saying, you know what, all that proved itself out. And as we go forward, of course, that gives us more confidence in what we're doing. But I think there's been lots of stories of different things that we've been able to help clients do, whether it's sophisticated estate planning techniques or just telling them, no, we don't want to sell everything today. It's going to be okay, to that kind of basic stuff. So it's been super gratifying to me.
Excellent. Thank you very much for sharing that. Matt, anything you'd like to add?
Yeah, I'll give you two ends of the spectrum. One is, it's an interesting thing. We all know that when we're going to either go through it or we've gone through it with the emotional experience of retiring. You're going from, hey, we got this regular income coming in, and suddenly the income stream changes and you're more dependent on your investment portfolio. So I've always found it's interesting to see people go through this and help them through this, because the relationship starts when they retire. It's suddenly like they're looking at, okay, Matt, you are going to grow this portfolio, right? And you're going to make sure that I have enough income to live on cash flow to live on. So it becomes very close. So it's not for everybody, but a lot of clients will really look closely, watch every move we make, and get very nervous, want constant updates about what's going on. And rightfully so. It's enjoyable to see that. But it's also enjoyable to see how it transitions the relationship, because they start off very nervous, but over time, as we've shown them and we prove ourselves, that it becomes very interesting. So the conversation really steers way away from investment management with the update meetings, and it gets back to the financial plan. And that to me is very rewarding. It's more laughing and enjoying the meeting and saying, hey, we feel comfortable, than the nervousness. And then to go to the other end of the spectrum, something I really enjoy too is, and there was just another example of this a couple of weeks ago, where a client will come to me and say, could you educate our children on investing? And I think that's really interesting. That's one thing I thought with my own children is, like, to this day, I want them to understand, you may not love investing, you may not want to be hands-on with your investing, but it's almost like owning a car too. You really want to at least know how it works. So if you do hire somebody, or if you're building your 401k plan, you should have an understanding of the markets itself and how they work and have a comfort level there. And I think that's great, because I go in and talk to them and just give them an understanding of, like, how the markets work, things to think about when they're looking at it, and answer questions for them. So it starts off being an educational type thing, but it's gone on now to, we have, clients' children who, either become clients, or, I can mentor them, as they go through different experience and learning about the investment and how it all works.
Awesome, mate. I think that kind of begs a follow-up question on my part, which is one of the biggest things that I know I've done a lot of reading about kind of in the financial space is just, I think one of the missed opportunities for a lot of firms is that they don't talk to their clients' kids. And you're looking at different directions, and you're looking at them kind of very proud that you've helped put them financially stable. But I think that is one of the things that it is all about education in a lot of respects, especially with the younger generation. And what they will eventually graduate college and become financial advisory clients as well, of somebody's. So it's great to hear that you guys already are doing that. I have one final question. At Harbor, we're firm believers in active management, though it's important to acknowledge that every financial expert has their own unique perspective. From your experience, what is your take on active management, and where have you seen it making the most significant difference? Let's start with you, Jason.
Well, this is more Matt's wheelhouse than mine. But when clients do come up with those questions about how we feel about that, I just take the line that we've always done, and there's a mix of it for us. There's some passive and there's some active. So when it comes to that, we're looking at, from an investment committee perspective, what is suitable for basically what sector or section we want to look in. So that's, to us, it's not all or nothing, but Matt can talk more to that than I can.
I think one of the things that, having asked this question several times, being active management can imply that you're choosing a passive, approach over an actively managed fund. So that's really kind of one of the things that every decision we make turns out to be active in some sense or another. So that's a great answer. And thank you. And I think my personal belief is the best way is a union of the two approaches. Matt, would love to hear your response.
Yeah, no, I agree with that completely. And I think it is interesting. You hit on a great point, because a lot of people, when they ask that question, are you passive or active? I look at it as we are active, but we use passive products too. So it's important to look at that. But to be specific, to answer your question, I think there's some markets that are much more efficient, and it's kind of, you have to weigh, what value add am I offering here? And could it be very small, or is there a larger alpha that I could achieve within those markets by being more active? So it's why we use a blend. And there's some markets that are more efficient than others. And what's interesting, I just read an article the other day where, that is coming out about talking about the markets are becoming more inefficient. And I think there's some reality to that thought as well. But I look at different sectors. So the S&P 500, the S&P 500 is a tough foe if you're trying to beat it, sometimes with active. So I think it's important to have an exposure to the S&P 500. So it increases your odds of making sure you're meeting your goals and performing. But you can get into other sectors, smaller cap stocks. You can get into emerging markets, things like that, where those markets are a little bit more inefficient. And I think it really provides the need for an active approach. I also strongly believe in that, maybe because I started as a bond trader, is that the fixed income markets, I think, are very inefficient. And I think being active in those markets makes a lot of sense. Commodity markets, same thing. I think those can be very inefficient markets. And just to buy the index, I think you leave a lot on the table there. So you need to look at active approaches there and so forth. And it really boils down to, in the end, you're saying, okay, if I'm in this sector, I could either buy the index or I could be active or I could do a blend of the approach. But the overall goal is to beat the index post fees and to improve the overall return profile for the clients. And the last thing I say on this too is I think it doesn't get as much credit, but active a lot of times is a great downside protector for markets. We talk about all the time just the upside, what's the best performance. But in down markets, you find active approaches can be very helpful to limit the downside risk, which therefore allows us to maintain our portfolios through multiple market environments. So it's an important thing that we look at with all investing and building our overall portfolio structure.
Excellent. And I read the same article, by the way. I like to geek out on that stuff as well.
I know. Right.
Last but not least, gentlemen, how can people find you?
I think these days, of course, anyone's going to look us up. They're going to look us up on the web. So our website address is skwealth.com.
Excellent. Thank you very much for joining me today. I really enjoyed this conversation, and I love your approach to your clients and financial advising.
You're welcome, and thank you very much.
Thank you.
Thank you both, gentlemen. What we are going to move on to my favorite segment of the podcast, which is I like to call the lightning round. However, they make me call it officially 60 seconds with Jason Archambault and Matt Neyland. Nickname?
Jason.
Matt.
Profession if you weren't in finance?
Architect.
A botanist.
Best professional advice you've ever received?
Say please and thank you. Show up on time and always do what you say you're going to do.
Each interaction is different and react to it in that way. Listen to people about their own experience and treat them as an individual.
Bucket list travel destination?
The Galapagos.
Back to Italy.
What never fails to make you laugh?
Matt Neyland.
My wife.
What's something you wish you were better at?
Sports.
Home repair.
What piece of advice would you give your younger self?
To think of cash outlays as investments rather than expenses.
The oxen are slow, but the earth is patient.
What's one question you think all clients should ask their financial advisor?
How are you compensated?
How is the advisor being compensated? And really understand how that works.
Most rewarding part of your job?
Seeing clients being able to achieve their goals.
They'd love to see clients' portfolios grow and they meet their goals.
Favorite way to get active?
Working out.
Exercise.
Whether you're a seasoned advisor or just getting started, The Active Advisor, brought to you by Harbor Capital, offers professional insights for the financial advisor community. Visit us at harborcapital.com to learn more. And don't forget to subscribe to The Active Advisor on Apple, Spotify, Google Podcasts, or wherever you listen to podcasts to stay up to date on investment trends, tried and tested research methods, and what your industry peers are up to. From all of us at Harbor Capital, thanks for tuning in.
And now for important disclosures. This material is for informational purposes and is not intended to be relied upon as a forecast, research, or investment advice, and is not a recommendation, offer, or solicitation to buy or sell any securities or adopt any investment strategy. The opinions expressed are as of 6th of September 2024 and are subject to change. The opinions expressed by the speakers do not necessarily represent the views of Harbor Capital Advisors, Inc. The information and opinions contained in this material are derived from proprietary and non-proprietary sources deemed by Harbor Capital Advisors, Inc. to be reliable and are not necessarily all-inclusive and are not guaranteed as to accuracy. This material may contain forward-looking information that is not purely historical in nature. Such information may include, among other things, projections and forecasts. There is no guarantee that any of these views will come to pass. This material may not be representative of the experience of other individuals. Reliance upon information in this material is at the sole discretion of the viewer. This material is not legal, tax, or accounting advice. Please consult with a qualified professional for this type of advice. Investing involves risk, including the risk of loss. Stock markets are volatile, and equity values can decline significantly in response to adverse issuer, political, regulatory, market, and economic conditions. Fixed income investments are affected by interest rate changes and the creditworthiness of issuers. As interest rates rise, the values of fixed income securities are likely to decrease. Specific companies and issuers are mentioned for educational purposes only and should not be deemed a recommendation to buy or sell any securities. Any companies mentioned do not necessarily represent current or future holdings of any investment products. Harbor Capital Advisors Inc. does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. This material is prepared by Harbor Capital Advisors Inc. Harbor Capital Advisors Inc. is not affiliated with SKWealth Management. All trademarks or product names mentioned herein are the property of their respective owners. Copyright 2023 Harbor Capital Advisors Inc. All rights reserved.